For many American homeowners, the insurance bill is no longer a quiet line item. It has become another major housing cost. A payment that once sat inside the monthly mortgage bill is now harder to ignore. It appears through the escrow account. It sits beside property taxes. And for some households, it arrives as a sudden increase in the cost of keeping the same home they already bought. That is why this issue has become part of the larger cost of living story. It is not only about insurance companies. It is not only about storms, wildfires, or state regulation. The real issue is what happens when another fixed cost rises faster than many household budgets can comfortably absorb. For a middle-class family, a higher insurance premium does not remain an accounting detail. It competes with groceries. It competes with gas. It competes with utility bills, car payments, credit card balances, medical costs, and retirement savings. And for most homeowners with a mortgage, insurance is not optional. If the lender requires coverage, the household has to pay for it. That is how an insurance bill can begin to feel like a second mortgage. The clearest official warning came from the U.S. Treasury's Federal Insurance Office. In a major report released in January 2025, the office examined more than 246 million homeowners insurance policies from more than 330 insurers, covering the years 2018 through 2022. The report found that homeowners insurance premiums rose 8.7% faster than inflation during that period. That means insurance was not simply rising with the general cost of living, it was rising faster. For households already dealing with higher prices across the budget, insurance became another pressure point. The report also showed that the burden is not evenly distributed. In the highest climate risk zip codes, average homeowners insurance premiums were $2,321. That was 82% higher than in the lowest risk zip codes. The economic meaning is straightforward. Where the risk is higher, the cost of protection tends to be higher. But households do not experience insurance pricing as a risk model. They experience it as a bill. They experience it when the monthly mortgage payment changes. They experience it when the escrow account comes up short. They experience it when they try to shop for a cheaper policy and find that the options are limited, and the problem is not only price. The Treasury report found that non-renewal rates were about 80% higher in the highest risk zip codes than in the lowest risk zip codes. That means some homeowners are not only paying more. Some are also facing greater difficulty keeping coverage. For ordinary households, this changes the meaning of housing stability. A home is supposed to be the stable part of the budget. But when insurance becomes more expensive, harder to obtain, or less predictable, that stability weakens. The system behind this story begins with risk. Insurance works by pooling risk across many policyholders. Insurers collect premiums, estimate future claims, and price policies so they can cover expected losses. When expected losses rise, when rebuilding costs rise, when homes become more expensive to replace, and when reinsurance becomes more costly, those pressures can move into premiums. Most households see only the final result. A storm, wildfire, hail event, or other disaster can create large insured losses. Those losses affect insurers. Insurers may rely on reinsurance, which is insurance for insurance companies. If that protection becomes more expensive, insurers face another cost pressure. At the same time, if rebuilding a damaged home costs more, each claim becomes more expensive. Data from the Insurance Information Institute and ESO showed that average homeowners' claim severity rose from $13,884 in 2019 to $20,060 in 2023. That matters because it shows that the cost of a claim has been rising. When claims become more expensive, the insurance system has to absorb that cost. It can affect premiums. It can affect underwriting. It can affect availability. And eventually, it can affect the monthly budget of someone who has never filed a major claim. A homeowner does not need to personally experience a disaster to feel the financial consequences of a more expensive insurance market. The pressure can arrive through the premium. In 2024, homeowners' multi-peril premiums increased 13%, according to the Treasury's 2025 Insurance Industry Report. The report said the increase was largely connected to rate increases and still rising home values. If the insured value of homes rises, and if the cost to repair or replace those homes rises, the insurance bill can rise with it. For households, that means the same home can become more expensive to keep. A family may have bought a home years ago. The mortgage rate may be fixed. The household may believe its largest housing cost is predictable, but insurance and property taxes can still change. And when those costs are escrowed into the monthly payment, a fixed-rate mortgage does not always mean a fixed housing bill. That is the part many homeowners are now confronting. The mortgage itself may not have changed, the cost of staying insured has. The pressure also reaches renters, though less directly. The Federal Reserve found that multifamily property insurance costs rose from $39 per unit per month in 2019 to $68 in 2024. In real terms, renters usually do not see that bill, apartment owners do. Property insurance is part of operating costs. When that cost rises, it may become part of the rent calculation. The Federal Reserve estimated that rising insurance costs since 2019 may have added about $7 to $12 per month to rents. On its own, that number may not appear large. But for renters, it arrives alongside other costs: rent, utilities, car insurance, food, medical expenses, and debt payments all compete for the same monthly income. A modest increase in one category can combine with pressure from many others. That is why insurance matters even for households that do not own a home. The issue also affects lower-income homeowners in a different way. The Federal Reserve's 2024 household survey found that 29% of homeowners with income below $25,000 reported having no homeowners insurance on their primary residence. That is an affordability warning. For higher-income households, a rising premium may be difficult but manageable. For lower-income homeowners, the same increase can create a more serious trade-off: keep paying, reduce spending elsewhere, or go without coverage if they are able to. Going without insurance may reduce the monthly burden in the short term, but it also leaves the household financially exposed if damage occurs. That turns an affordability problem into a risk problem. A household that cannot afford coverage may be more vulnerable after a disaster, fire, or major repair event. And for many families, home equity is one of their most important financial assets. The broader disaster backdrop helps explain why the issue is receiving more attention. In 2024, NOAA recorded $27 billion disasters, with total costs of $182.7 billion. That does not mean every insurance increase is caused by a single disaster or one storm season. It does mean the insurance market is operating in an environment where large loss events are a major cost factor. The causes are layered. Climate and disaster risk are confirmed parts of the pressure. Higher claim severity is part of the pressure. Higher home values and rebuilding costs are part of the pressure. Higher reinsurance costs are part of the pressure. But it would be misleading to reduce the entire issue to one cause. State regulation, local market conditions, litigation costs in some places, population growth in high-risk regions, and insurer decisions may also matter. The mix differs by state. It differs by zip code. It differs by type of risk. That is why the national insurance story can feel uneven. Some households may see modest increases. Others may see sharp jumps. Some may be able to shop for better coverage. Others may find fewer options. Some states may show signs of improvement in certain markets, while other areas remain under pressure. This is not one uniform national crisis. It is a fragmented affordability problem that hits hardest where risk, replacement costs, and market stress overlap. For the middle class, the challenge is not only the size of one bill. It is the number of bills rising at the same time. A household can often adjust to one increase, But when insurance rises alongside groceries, utilities, transportation, and debt payments, the room for adjustment becomes smaller. That is why the insurance bill has become such a visible part of the cost of living squeeze. It is attached to the home, and the home is supposed to be the stable part of the budget. The consumer view reflects that pressure. Pew reported in 2026 that 71% of U.S. homeowners surveyed said their homeowners' insurance costs had gone up over the last few years. That is not a technical insurance market measure, it is a household measure. It shows that most homeowners are noticing the increase. They may not know the details of reinsurance, they may not read state rate filings, they may not follow claim severity data, but they know the bill has changed. And when a recurring bill changes, the household has to respond. Some families may reduce discretionary spending. Some may delay repairs. Some may raise deductibles if they can. Some may shop for coverage. Some may use savings. Others may fall behind somewhere else. Those choices do not always appear in the premium data. But that is where the economic story reaches the household. The government data view is that homeowners insurance is becoming more expensive and less available in higher risk areas. The industry view is that insurers are responding to higher claims, higher rebuilding costs, higher home values, and higher risk transfer costs. The consumer view is that another essential household cost is rising, often with limited control for the person paying it. Those views can coexist. Insurance is designed to protect households from financial shock. But when the cost of that protection rises too quickly, the protection itself becomes a source of pressure. And the impact extends beyond homeowners. Renters may feel it through operating costs that partly pass into rent. Buyers may feel it when insurance quotes affect affordability. Retirees may feel it on fixed incomes. Lower-income homeowners may face the risk of being uninsured. Middle-class families may feel it through escrow adjustments that make a familiar monthly payment suddenly unfamiliar. This is not only about one bill, it is about the rising cost of staying financially protected in a more expensive housing system. The current picture is serious, but uneven. Insurance costs remain a major pressure point. The burden varies by state, by zip code, by property type, and by risk level. Some markets may improve, others may remain strained. The future path depends on disaster losses, rebuilding costs, reinsurance costs, state rate decisions, insurer behavior, and the ability of households to keep up. What remains uncertain is how much more pressure households can absorb. A homeowner can plan for a mortgage payment. It is much harder to plan for an insurance market that changes around them. That is why the insurance bill has become one of the most important cost of living stories in America. Not because it is the largest bill for every household, but because it is becoming another fixed cost in a budget that already has too many fixed costs. For many families, the question is no longer only whether they can afford to buy a home. It is whether they can afford to keep protecting the one they already have.